I always worry about things. I think I worry when I don't worry, right? So I think just because you change months doesn't really change the narrative. And the narrative is that there are pockets of the economy that are doing well, that are recovering. Housing, auto, parts of consumer, manufacturing. Did you see those numbers this morning at the ISM? The new orders jumped 5 points. The ISM itself was the best number since November 2018. So manufacturing is absolutely recovering, and I would even argue is in a V recovery. But then, of course, you have pockets of the economy that are not doing well, that are struggling. We have 1 million jobs, initial claims rather, that we keep getting every single week. And that is not a good number to get. And that is why I think you're going to see a fiscal package. You also still have a lot of troubling things happening with regards to travel and leisure and restaurants and that sort of thing. So I do think that you get the fiscal package. I don't think this changes in terms of my investments, because I think as you recover, the economy recovers, you get through the elections, I think profits recover, and we can see next year even better profits.
Josh, how about you? Are you worried by valuations? We saw yesterday, I think it was Tony Dwyer, basically throw up his hands and say, I can't even begin to predict values because I can't even put a price target on the S&P because I can't predict what or even know what the valuations are. Are you concerned that the runaway stocks, which have been growth and technology, will continue to be the market leaders, and that the leadership in the market is too narrow?
Well, the leadership in the market by sector has actually been improving throughout the entire summer. So I don't know that it's too narrow in terms of where it's coming from. On an individual stock level, it's a little bit trickier, Tyler. But I would just say, if you think about the way August ended, we go into September, we had new monthly closing highs in everything from consumer staples to healthcare to consumer discretionary to technology, obviously, to materials and communication services. So this is like almost every important sector in the market, all making new highs. Now, the counter to that is there are a handful of very large stocks in each of those sectors doing most of the heavy lifting. So I think we have to just take that for what it is and look at the bigger picture, which is the stock market in an uptrend or not? It's in an uptrend. Are new highs in the stock market bullish or bearish historically? They're bullish. New highs beget more new highs until they don't. But you can have decades where stocks make new highs without a significant bear market. So if we're just thinking about weight of the evidence approach and we're just saying, what is the big picture? The big picture is that stocks are going up, not just in the U.S., but around the world. All of the things that Stephanie said about the economy are true. But the market is eating that information on a minute-by-minute basis, putting it into its price and moving forward. And so that's the way that I would think about what we're seeing right now as an investor.
Jim, how do you react to what you've just heard? Is there any sense in your world that this is a good party by any stretch of the imagination, but that the party may be getting toward the 11th hour?
Yeah, well, look, what Josh and Stephanie just said, those are factually correct statements. Nonetheless, I do find myself worried. I see a vulnerability that can be cured, and I'd like it to be cured. And that vulnerability is simply that if you look at the leadership, notwithstanding that it has closed somewhat recently, it's still a pretty stark difference between the haves and the have-nots, and it's pretty concentrated. So, you know, the triple Qs year to date, NASDAQ 100 are up 38%. The S&P 500 equal weight is down 4% year to date, and that's the average stock experience, more or less. So it tells you that there is a concentration at the top, which also is measured. If you look at the S&P 500, the top 5 stocks are 26%. Apple alone is 7% of the market cap. Now, here's why that matters. I don't think those leaders need to come down, and I hope they don't. But what would be healthy is to see some spreading out of the returns to the rest of the markets. The vulnerability of what I speak is that if those top 5 come down for whatever reason, and it could be any reason, it could be fundamental, it could be technical, it could simply be that there are no buyers left to buy those stocks. If they come down in a disorderly fashion, they're liable to bring the market overall down with it. So that's the situation I'd like to avoid. And the way to avoid that is to see some spreading out of the leadership so that the S&P 500 equal weight in particular starts to break into positive territory and close that gap with the NASDAQ 100. That's what I'm looking for.